Hey, how's it going, guys? Have you realized that nowadays there are more and more fund managers calling for a bubble in the US stock market right now? But the market seems to completely ignore all these warnings and just keep going up. Are we truly in the biggest stock market bubble in our history? How exactly can we identify if we're in the bubble or not? In this video, I will share with you guys two most important indicators that you can use to identify if we have a bubble in the US equity market. And also, we'll go back to the history and take a look at how exactly these two indicators can help us detect the stock market bubbles and what these two bubble indicators are telling us about today's market. Alright, let's get started. If we look back to the past 100 years, although we have a couple of major bear markets, only two of them were actually caused by a bubble, which means we only had two major stock market bubbles in our history. There were the early 1930s, right before the Great Depression, and the late 1990s, the dot-com bubble. The rest of the bear markets in our history were actually not caused by the stock market bubble. For example, the famous 2008 global financial crisis was actually caused by the housing market bubble. So if we want to learn more about how the stock market bubble looks like and what factors that can create a bubble in the stocks, then the best examples that we can learn from are the early 1930s and the late 1990s. So when people talk about bubbles, the word they like to throw around is the valuation. You would definitely hear a lot of talking heads on the CNBC nowadays screaming in front of the TV, our valuation is too high, it's gonna be the worst bubble in our history. Guess what? They say it every single year. And the truth is, the mainstream media do it for the sake of attention, not education. We have to build our own independent thinking and the risk management process for our own investing. So, does valuation matter to our investing? Yes, it does. Valuation is an extremely important tool to help us build different financial models. But does valuation matter in helping us to identify a stock market bubble? Yes, it does, but unfortunately, most people use it in a completely wrong ways. Let me explain. During a healthy bull market, the absolute valuation levels will always be overstretched, which is completely normal. Because this is exactly how the bull market works. It's the forward pricing mechanism that is trying to price in with discounting the near future accelerating growth as much as they can. If you understand this, then you will understand in the stock market bubble, the absolute valuation level doesn't really matter. What matters is the rate of change of the valuation levels. This is extremely important. Once you understand the basic market mechanism, then we can move on and take a look at what exactly caused a stock market bubble and what are the indicators that we can use to help us identify it. If we study the history, we can learn that among all the things that cause the stock market bubbles, we can categorize them into two major factors. First is the rate of change of the total market price to earnings ratio. And the second is the level of general public interest. Let's start with the first one and see what the history can show us. So this is the chart of 10-year average inflation-adjusted price-to-earnings ratio of the top 5 companies over the past 150 years. You can easily tell the two bubbles in this chart, during the late 1920s to the early 1930s, and also during the late 1990s to 2000. We can see that the rate of change of the price-to-earnings ratio in those two periods had a massive parabolic move to the upside. The stock price was moving away from their fundamentals at an increasing pace, which means the higher the price goes, there are actually more people jumping into the stock market, chasing the price and pushing the price even higher. That is the typical sign showing an extreme speculation sentiment in the market, and that is the textbook definition of a bubble. Also, this chart can show us that the absolute value of the PE ratio doesn't really matter when the stock market is building a bubble. The market can stay irrational way much longer than investors' sanity. For example, before the 1930s, the average PE ratio was around 15, and during the bubble, it was pushed to 30. Before the 2000s, the average PE ratio was around 20, and during the dot-com bubble, it was pushed to 45. Historically, the absolute value of PE level has been one of the worst indicators to identify the bubbles. But however, the rate of change of price to earnings as the indicator worked perfectly every single time. Alright, now let's move on to the next indicator, the level of general public interest, aka how many retail investors are participating in the stock market. You probably heard something like this before. When your taxi driver starts showing off how much money they're making from the stock market, it's probably the market top. This chart provided by Google Ngram is a very useful tool to help us have a rough idea where the level of general public interest is. Google has collected all the keywords like buy stocks, stock bubbles, stock market bubbles, this kind of words appear in all the English language books and newspapers all the way from 1900 to 2020. The green line shows the keywords of buy stocks. As we can see, the green line had only two peaks in the last 120 years. 1930 and the 2000. And both of these two peaks were exactly the tops of the stock market bubble as well. The sudden rising of general public interest and the retail speculation was another key driver behind those two stock market bubbles in our history. No exception. So these are the two most simplified but also extremely useful indicators that can help us identify if we're in a stock market bubble or not. Of course, the question everyone want to ask is, where are we now? Are we really in a new stock market bubble, or is just extension of another healthy bull market? Let's take a look at these two indicators and see what they tell us. First, the 10-year average price to earnings ratio. Currently, we're at a 35. Although it's above the historical average level, you should understand that because of the extreme fiscal stimulus and the zero interest rate, 35 is actually a very reasonable valuation level, especially if the Federal Reserve decides to keep such a low interest rate for a much longer time and they continue printing the helicopter money. We can expect this PE ratio to slowly go up even further. But as we mentioned earlier, the absolute price to earnings ratio doesn't do a proper job to tell the bubble. What matters is the rate of change, or how steep the slope is. As we can see, there's no parabolic move to the upside yet, which is a positive sign. Well, there is a possibility we might see a parabolic move in the near future, but as for now, the rate of change of 10-year average price to earnings is telling us we're not in a bubble yet. Alright, the next indicator, the level of general public interest. Well, this is an interesting one. The data of this chart ends at the early of the year 2020. At least before the 2020, we can confirm that we haven't seen another potential peak in the level of general public interest in the stock market yet. However, as we all can imagine, there are definitely way many more retail participants who are jumping into the stock market over the past couple of months, especially the early of this year with the Wall Street bets and the GameStop mania. We should expect this chart will have a dramatic bounce to the upside when the new data comes in. But we actually have another way to find out, with Google Trends. If we search buy stocks on Google Trends, we can see that there's actually a massive jump in the public interest around March 2020. And right now, this level of interest is actually making a new high. We can even compare it with the public interest level back in 2008 before the crash. We can see that the differences are huge, and that is a really dangerous sign we should pay attention to. This sudden massive jump to the upside is definitely indicating that there is a huge amount of retail traders jumping into the stock market, and this could be the beginning of building a new stock market bubble. So in conclusion, based on the rate of change of S&P 500 price to earnings, we're not in the middle of the stock market bubble yet, but based on a sudden massive jump in the retail participants and the speculations, the probability that we're at the start of a new market bubble is extremely high. We should expect the market will continue going up from the current level with higher than average volatility. So there's still much more room to the upside, but we should definitely pay close attention to the rate of change in the 10-year average price to earnings ratio. If we see a potential parabolic move to the upside in the PE, then that is the danger signal for us to get out. Before we go, I want to share with you guys one more bubble indicator I've been watching recently. It's called the Nasdaq to Russell ratio. Actually, I talked about it a couple of times before. If you're new here, a Nasdaq to Russell ratio is basically an indicator that measures how concentrated the stock market is over the large cap tech companies. For example, back in 2000, the dot-com bubble, we can see that there was a massive parabolic move to the upside. This indicates that investors were heavily speculating on those tech companies, which was the major cause of the dot-com bubble. The early of last year, 2020, we were seeing a similar parabolic move to the upside again. That gave us some warning signals. But luckily, due to the extreme fiscal support from the Federal Reserve, we're seeing this ratio is slowly going down. That indicates the concentration over the large cap tech companies is actually fading away. The capital has been rotating from the large cap tech companies to the small caps again over the past 6 months. This is a pretty good sign of a strong economic recovery expectation from the market, which is exactly what we want to see in the new bull market. But the overall concentration still remains really high compared with the normal level, so we're still not out of the woods yet. I would expect this ratio will continue going down from this level, and the Russell 2000 will outperform the large caps over a longer period of time. Cool, so this is the new interesting indicator I've been watching recently. But in general, if you want to identify a stock market bubble, the two indicators we talked about earlier will be good enough to do the job for you. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market. And I also share some educational contents to help your investing journey just like this one. If you are interested in the world of finance, the business, and find my videos being valuable to you, please consider subscribing. Again, thanks so much for watching guys, and I will see you guys soon.